in here. So we're going to talk about how to play earnings, kind of an earnings game plan that I put together and use every earnings season. And there's one really great option strategy I love to use, which we'll get into quite a bit here. But that being said, let us get started here on this live event. So a little background on myself. I've been actively trading for now over 40 years, trading options for over 30 years. Started out my trading career on the oil side, trading cargoes of oil and products and things like that, and went on to a company called Trans World Oil back in the mid 80s, and was with them for about 17 years and ran their international trading desk for 10 years out of Bermuda. So at that time, Trans World was one of the largest oil trading companies in the world. So it was a fantastic experience as far as all the different markets that we were trading, and that's where I started trading options. So fast forward, started power cycle trading back in about 2010, and just been basically looking at education based on options and directional trading. And one thing that's really been interesting are trading earnings and the release of earnings and taking advantage of the high volatility spikes and things like that. So that's what we're going to really touch on here tonight. So the following presentation is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So have you noticed that earnings can be really horrendous and the stock goes up, or earnings are going to be off the wall chart, fantastic, and the stock tanks? So this is what I call the earnings confusion. So you really never know which way the market's going to go a lot of times based on the earnings announcement release that's coming out. So it's hard to trade because of the unknown direction. So when a company has an earnings conference schedule, many times there is speculation not only into the accuracy of projected earnings per share, but also other factors as well. So it could be that they're going to do some layoffs. It could be that they're having debt problems or whatever. Sometimes a lot of things will pop out that the market wasn't aware of during earnings conference call, and that's what really makes the uncertainty build and pushes volatility higher. So it's this uncertainty that typically causes an increase in the volatility in the shares of a specific stock around their earnings period. And this is the big diamond in the rough. So it's this temporary parabolic rise in volatility that spikes the option prices higher. So here's what happens. Traders tend to stay on the sidelines going into the days leading up to an earnings conference call. Now, the call buyers what happens will swap out shares of their long stock for call options so they can participate in a rise should the shares move higher, but they want to limit the potential loss should the shares trade lower. So, swap shares for calls, and that pushes demand. So that's what starts really pushing up the implied volatility. So additionally, you have the put buyers forcing the option prices higher as they try to protect their positions from any major downside movement. So it's all this concentrated option buying, in many cases, will drastically expand the volatility levels of a stock being traded into the earnings release. So as an individual trader, we can take advantage of all this uncertainty and volatility in order to capture profits. So no matter what those crazy earning reactions are, if you just know the right setups to use and how to set the trade up. So step one, we want to identify and qualify a particular stock by we want to look at its past performance. So we want to see what the probabilities of the stock has been in the past as to, does it go up, does it go down real hard, does it have big, huge moves, or does it tend to go nowhere? So we want to look at the performance to see if we can highlight any kind of trend of a stock as it heads into its earnings, during earnings release, and even after. So we want to find those stocks that have their earnings release during a weekly option expiration. So we want to be able to use weeklies to take advantage of the fast movements in a short period of time in order to take advantage of also theta decay and implied volatility crush. So weeklies are the perfect vehicle. Now, the second step is to evaluate and look back at past performance to see what has volatility done previously to a specific stock as it moves into its earnings release, and even then after. So, as a trader prepared for this, you can look for the dramatic increase in a stock volatility as it approaches that earnings release. Now, normally a stock will have about 25 to 40% kind of implied volatility is kind of the norm. But the week of earnings, this volatility can easily move to extremes. So it can be, volatility can push normal volatility levels to double, or even sometimes we'll see them even go 3 times the normal level. And this is what we want to look for, because we can take advantage of these extreme implied volatility spikes by, doing certain option strategies that take advantage of selling volatility. Now here's an example. So here's NVIDIA, which has typically high implied volatility normally, but here it was. You can see the extremes of this. This was on a Thursday. Earnings were going to be released after the close on Thursday. So you can see on the option chain here, it's got 1 day to expiration. Now on the 14th was going to be the option expiration. So coming in, it was trading right here at 270. And you can see 1 day implied volatility was up to 114%. So normally you'll see, NVIDIA's around about 40%. So you can see that huge spike, 3 times the usual level here on NVIDIA. So the price is at 270. Now look the next day. So this number here, 114 implied volatility. Now the next day after the earnings were released and all the uncertainty is taken out, you can see that the implied volatility here collapses to 35%. So back to that kind of normal level. And in this situation, we had that huge volatility crush, but you also had a spike in price, and it went up 7.5% in 1 day to 291. So there are a lot of things that you can do to take advantage of either a big price spike, or the big thing is the volatility crush. So here's what it looked like on the chart. It was trading right in here going into earnings. You can see how the implied volatility had been pushing up as it headed towards that earnings date. And so then after the earnings release, it spikes up here 7.5%, but implied volatility, you can see, collapses to the downside. So for this reason, it's essential to put together a watch list of stocks to monitor closely, due to the fact that they may not all present an equal trading opportunity for an earnings trade. So we want to remember the goal is to take advantage of this temporary rise in the volatility, as well as past earnings performance and the probabilities to see what they've done in the past. Now, there are 3 types of cycle trades that we can do around an earnings season around a specific stock. So the first one is a trend trade setup on a specific stock as it heads into its earnings release. So a lot of times stocks will trend either higher or lower into their earnings release. The second trade is just what we call the earnings release trade. So kind of a non-directional trade setup, which we'll go through, that we don't know which way it's going to go. It could go up or down, but we want to take advantage of that high volatility to sell it. And then the third trade is a lot of times after the earnings release, you'll get a post-earnings trend trade, either up or down, from a specific stock. So here's an example of CRM. This actually had 3 of these cycle trades within its own one earnings season. So here was CRM trending higher. You can see the price here starting to trend up. So the price was itself trending higher. But then if you look down here, the blue here is the implied volatility. So the implied volatility is also trending higher. So it's a great way if you have a stock that's starting to trend towards its earnings. It's a great way to buy that earnings series that it's going to be the earnings release series, and then you get the double kind of benefit from the increase in implied volatility and also the increase in price itself. So you can do this and take advantage of it either up or down. So it's a great way to play that implied volatility spiking higher, which pushes the price up as well. Now, the second trade is what we call that non-directional trade, where we want to take advantage of that volatility collapse, of this volatility that's spiking higher. So with this type of strategy, what we want to do is we want to, if you do have a trading trade into earnings, take it off before the earnings release. And then we look for that volatility crush. And so there are a number of different option strategies that I'll cover here tonight that you can use to sell that volatility and play what we call volatility crush. Then the third trade is after earnings release. A lot of times a stock will start trending either back up. If the earnings are good, it might start a post-trend up, or if their earnings are bad, it might start that trend down. So you have three potential opportunities, around an earnings season for the different trade setups you can do. So here's another example. Here was Nike, and this was, you can see Nike trending. Let me get my pointer here. For this one, you can see Nike was trending down on price, but the implied volatility, it was trending up. So this is moving that price. Like if you buy the option series of the week of the earnings release, if you're buying puts, those puts are going to increase in value because the implied volatility is going up. Or if you were trending higher, you buy the calls, and those are going to get the benefit. So that's, another example of taking advantage of that volatility collapse and see what that is. So here you can see how it collapsed after those earnings were released. So step 3 is we want to put together a checklist. I like to make things as kind of systematic as possible. So kind of systematize your setups by a process of a checklist of things you want to look for each trade that you're setting up before you actually put the trade on. So first off, the stock should have options and good option liquidity. Okay, so we want to have good liquidity, we want to have options, we want to have weekly options, so we can take advantage of the kind of the short-term nature. And we're looking for high pre-earnings volatility, so we want higher implied volatility in order to sell that volatility for that volatility collapse. The other thing we look for is it must have price moves that were either greater than 5% up or down or less than 7%. So what this is looking for is if you have a specific stock that shows a tendency over its history, say I like to go back at least 4 earnings cycles. So let's say you have a stock that has a tendency to move 5% or higher, so it tends to have big price spikes. So, there are certain situations stocks might just have a huge spike up or a big spike down. So we can look at the earnings history to see if that's a consistent pattern. If so, there's a certain option strategy to use. Now, the other thing that I like to do is if it doesn't have big moves and it tends to move, kind of more sideways, so it doesn't have big spikes. So maybe it's trading here and it maybe doesn't go down, but maybe 5% down or 5% up. So with this type of strategy, what we're looking for is to sell the volatility. So we're looking for kind of a tighter range versus a big spike. So we have different ways we can play those two type of situations. So we want to then, before the trade setup, we want to calculate the implied stock move the day of its earnings release to see what the forecasted trade range would be up or down. We want to look to using this information to put together what I call price target analysis. This will identify potentially where the price of your security could go either up or down. And then from that, we can select the appropriate weekly option strategy to use, entry plan, exit plan, and start the trade. So kind of a checklist of these things need to be done to make sure you follow them each and every time. Now here's an example of kind of the data that I like to look at and how you can kind of use this to give yourself an idea of maybe what to do for a certain trade. So here's Roku, and Roku is like NVIDIA, tends to have a really high implied volatility in general. And so in this example, you can see that Roku, 1 day to expiration, so this is like on a Thursday, so earnings are going to be released after the close. You can see the big spike moved up to over 200% implied volatility. Now normally it's around 70 or 60 or 70, but now it's doubled and it's up here to this 212. So big huge spike. So it's trading here at 137.50, and then the expected move is right here. So the market's expecting it could go up either 11.64% up or down. So it could have a huge move either to the upside or downside of at least 11%. And a lot of times we'll see moves of even greater than that one standard deviation. But that shows you the potential power that an earnings can have, and that implied volatility is what we want to see at sometimes we can sell it to take advantage of it. So you can see here the next day after the earnings released, Now it's trading at it was trading at 137 before the earnings release, and now it's trading at 127.65. So you can see volatility's collapsed here. It's gone down to 73%, and also then price though also spiked down 7% in one day. So these are the opportunities that are out there if you know which strategy to look at to take advantage of it. So here again, here's 212% implied volatility, and then the day after it's back down to kind of the normal range. So here's what I like to look at. These are kind of the earnings statistics that I can go through to get an idea of what it's done in the past. So for example, Roku, you can see the implied move history right here tends to have these big moves, 10% or greater, 11, 14, 14, etc. Now it's got 1 day at expiration. The release of the earnings were on a Thursday, so it's got 1 day to Friday expiration. And look at the big moves. Let's go back in time and history, and you can see it tends to have big moves. So here it was down about 7%, down 7, almost 8, down 6, down 16, up 20, 28. So Roku has huge potential moves, either up or down. So that tells us what kind of earnings trade to look at, and then also what kind of earnings trade to avoid. So if we look here to the data, put the data together, you can kind of see it more clearly. So put it on a little bit of a worksheet here, and you can see what the tendency is for Roku. So here an average of 8 cycles. So this is going back 8 earnings seasons to look at what it's done. So here you can see the implied move history. So going into the earnings release, it was up, expected move was over 10%, 11.63, 14.62. Now averaging all those up, you can see on average, over this 8 series of earnings, the average was 14.51% implied expected move. That was saying, okay, well, on average, Roku would either go up 14.5% or down 14.5%. But the interesting thing is here that if you look at what it actually did, it was actually had bigger moves than the average expected move. So this tells you what to do or what not to do. So in this case, you don't want to set up a trade to sell volatility because you usually get crushed. So with this one, you can see that the worst case scenario was about a 6% move up or down. So if you set a trade up for at least a move of 6% up or 6% down, that's a high probability trade. So over the past 8 series, it's been 100%. So I'll go through in a bit and show you the kind of strategy you can use to take advantage of that tendency for big price spikes up or down. So that's kind of the data that we want to look at, see what it's done. Now, the next thing is using weekly options and the power that they provide you. So I like to use weekly for all earnings trades to take advantage of the 2 key option pricing components, which are going to be time value, theta, and then the implied volatility. So the combination of these 2 pricing components, when used correctly, is what's going to create a winning low cost defined risk trade kind of trading formula for generating high returns on your trading capital and in a very short period of time. So you could see that these can be a trade that could be set up for just 1 day. So a very short period of time to work with. So if you get it right, these things are what I call lightning in a bottle. So if you could bottle it and do it every time, it's pretty exciting type of trades to play and be involved with. Now, if you just know which weekly and option strategy to use for the trade, how to construct it, then when to trade it, then the weeklies can produce some really exceptional fast profits due to the incredible leverage they provide, making them the perfect trading vehicle for an earnings trade. Now, the next thing is what that house has done. So there are a number of different strategies that we'll talk about, but what we want to do is we want to do what I call comparative option strategy analysis. So if we're looking to construct an earnings option trade, we want to look and evaluate the risk to reward or the return on your capital at risk between the various option strategies being used to compare and select which one would be the best risk reward for your trading goals or profile. So, and at times there are going to be more than one strategy that can be used, but you want to see and evaluate that risk reward to see if it's acceptable to you and to, kind of your trading goals. So what we're going to do is look at the different strategies now. So what are the strategies, how they work? So there are basically 4 option strategies that can be used to capture profits from the extreme price volatility that surrounds, every earnings season. And then each strategy works best based on certain circumstances. So the trading strategies used, these are all 4 non-directional, because again, we don't know what's going to happen. Is it going to go up or down? Now you might know, might think but then there's something that fouls up your game plan and goes the opposite way. So we want to tend to go non-directional. So to do this, the 4 strategies we can use is one is called the short iron condor spread. So these are option spreads, and this one is basically a debit spread. So this one is used for those stocks that have a tendency to have big price spikes, like in case of Roku or Nvidia. Now the other ones are basically we're selling volatility in these 3 other strategies. So the one is called the long iron condor credit spread. So it's a credit spread, and it's by credit spread, that means you're selling time and volatility. So we're going to be able to take advantage of volatility crush there. The other one that's also a credit spread is a long iron butterfly. All right, so another great credit spread to take advantage of that volatility crush, selling volatility in time. And then the 4th one is the one that we've really been using a lot, which is what I call the double lightning debit spread, or this is what's called a double calendar, which we'll go through. This thing has a great advantage because it's a spread that's done for a debit, but it's also taking advantage of selling volatility for vol crush, but also the potential for a post-trend after the earnings release, which these other 3 strategies don't provide. So that's the really cool thing. And this one, the double calendar, double lightning, is a super low risk earnings trade setup. Of all the other 3, this one is by far the cheapest and the less risk, and it gives you typically the best risk reward on your trade setup. So that's the one that we've been really going to. So the one earnings strategy that has really become that favorite to us is really, again, because it gives you low risk but high reward, and the flexibility of it for a post earnings trade is that double lightning or double calendar spread. So what this spread does, it's structured to provide a non-directional, very low defined risk but potential high reward earnings option strategy. So the strategy itself profits from one, selling volatility as a spread to capture the elevated volatility from the near-term option series that you short during the week of earnings, plus the longer dated option series behind it that you can profit from a move up or down based on a post-earnings trend. So we're selling volatility on the front end, and we're going to be long volatility on the back end. So we can also then have that flexibility. Second, you get the difference between the rate of premium decay or theta decay between the near term, which is going to have a higher theta than the back series. Okay, so we're going to sell that near term, get the theta decay accelerated, and then we're buying the series behind it to give us the potential for less theta decay. So we're playing the spread between the 2, thetas of the 2 spreads. So then the third thing is the directional component. So it's got a component where the long dated option is going to allow you to position and capture a post-earnings trend trade if you want to stay with that specific stock. So it really covers all the different aspects of a trade to take advantage of high volatility, but also potentially a directional move post-earnings. So again, remember, as a company moves into the day of its earnings release, the option volatility often reaches extreme levels of 2 to 3 times normal volatility due to all that uncertainty surrounding that earnings event coming up. Now, after the earnings release, all this uncertainty is removed and creates a collapse in the option volatility as it moves back to the normal levels. And this is what we call volatility crush, and this is what we want to try to take advantage of by selling volatility. Now, what sets the strategy apart, though, from the others that also sell volatility is that it can be adjusted into a directional trade after the earnings release, providing you a big potential for bigger profits from that directional move, so the post-earnings directional move. So when you look at the other three, it doesn't have that kind of flexibility. So we started using this back, I started using this back in 2020 and had really great results. So for all of 2021, we had 32 trades closed out, 29 were winners, 3 were losers, and 90% win rate. Now we're currently, I'll show you the results in here in a minute, but we're currently at, it's still about 85% winning rate. So these are really low risk trades with high winning percentage based on the way that they're structured. So let's take a look at the long double calendar. So here's an example on Starbucks. Okay, so it's non-directional, but it has that post earnings direction that we can use. So in this example, Starbucks was going to have the earnings on the 3rd, and at that point it was trading at $74 with expiration on the 6th. Okay, 3 days later. So on the 6th, it was trading at 76.48. So you can see here 74, and then it pushed up to 76. Now the expected move going into the trade was that the market was looking, based on the volatility, was looking for Starbucks to either move up 6.75% up or down. And what we did on this trade, we set the trade inside that expected move and set this one in this case for just a move of 4% up, but a potentially bigger move down. So here's where it was trading the day of the earnings release, and you can see after the release, implied volatility collapse, volatility crush, price spikes up, but then comes right back down. So again, you can see the implied volatility here in this option series. So you can see this 6 May, 3 days expiration at a 92.70 expected implied volatility. And then you can see the series behind it, 60.82, and you can see the normal volatility is about 40. Now the next day, after the earnings release, you can see the price went from 74.36 to 76.52, but that implied volatility collapsed back down to kind of the normal range of 68%. So that's what we're going to take advantage of. We're sell the front end, buy the back end, and then we get that implied volatility crush plus theta decay from the spread differential. So really cool structure to use to give you that kind of outcome. So here's what it looks like on the risk profile. In this trade here, you can see what it ended up doing. So this was set up, the risk on this trade was the 22 was a call calendar and a put calendar. So the total risk on this was $22 on the call calendar, 46 on the put calendar. So total risk on this spread is 68 bucks. So, and it's really hard to lose because the break-even points are so far out that you would rarely lose your full at risk because of the wide break-even points. So maybe you lose 20 bucks at worst case. But in this scenario, you can see that volatility collapsed and was trading right here at into expiration on the 6th. So the spread had gone from that spread of 40, 50, 68. Now it was trading a spread profit of $67. So the spread went from $68 to $135 per spread, or $67 per spread, which is a 99% return on that capital at risk. And that's from just selling volatility in time. So we're not even looking for direction. We're just selling volatility in time. So that's the sweet spot for most of these. Now, will every trade be a winner? No, unfortunately not. But what works is, again, using this kind of systematic approach for finding the highest probability trades. So let's go through a couple others to show you kind of the different ones that we can incorporate. So these are all non-directional type trades using weekly options. The first one will go back to Roku. So this is using what we call an iron condor debit spread for explosive price kind of spikes up or down. So with Roku, you can see it has a tendency for big moves. And just looking at its history, the tendency is for it to move even more than the expected move. So you can see here over 7 cycles in this situation, it's had an average of the implied volatility move, 13.98 expected move. But actually over the same period, it's actually had an average of an 18% up or down. And looking at the worst case, the smallest move was 6%. So again, setting a trade up for a move of either 6% or higher or 6% or lower is a high probability trade. In this situation over these 7 cycles, that was 100% winner. So this is what we do called the iron condor debit spread. So you can see the implied volatility here collapses, but price spikes up. So you can see that the price was trading right here and it spikes up here and then comes right back down. All right, so the expected move here going into the trade was 11.63, actually closed down 7.88%. The trade was set up for a move of 5% up or down. So all it had to do is move 5% up or 5% down. We don't care, just as long as it moves at least that amount, that will be a profit. So this is the iron condor debit spread to take advantage of that kind of scenario. So the earnings were on the 7th. It was trading at 137.50. Expiration was just the next day. Expected move 11.63% up or down. Trade set for 5% up because we saw that history. It tends to move at least 6% or greater. And then we can see the next day it was down 7.88. Set this up for 5%. This was a max profit. So you can see a risk here is the spread difference or spread risk of 155 per spread. No, I'm sorry, max profit. And the 45 was the actual profit. So you can see here, potential is your max profit 45, but your debit cost is 155 right here. So that's the max risk. So this one, we want it to go up 5% or down 5%, and that's going to give you that max profit of 45, which will be a 29% return. So that's a strategy that we can use just for a stock that has that tendency to big spikes. So just an example of that. Now another one, and this is what it looks like, the risk profile. So you can see here that Roku had this big move and was trading at right here at 126.66. So this was actually 7% down. We had it set for 5%. So we had all I had to do was close below that number there, which was 130. So it was a put debit spread, 132, 130. Okay, so put debit spread, and then here's a call debit spread here on this side. So trade above 144. So long call, short a call. So that's what that condor is: long a put, short a put. All right, taking advantage of price spikes. So that's one strategy you can use. And we used to use this one quite a bit, but have kind of really gravitated all the way to just the double calendar, and so you'll see why in a minute. So the other one is the iron butterfly credit spread. This is a really good one to bring in lots of credit, and this is done for what we call that volatility collapse. So this is one that we'd set up on Nike to show you kind of an example of how this one can work. So of all the different strategies, this one, if you get it right and it doesn't move, will give you the highest potential profit. So this was Nike entry was on the 27th. It was trading at 83.66. Expiration just the next day. So the expected move was for it was going to either the market was looking for it to go up or down 4.92%. You can see the implied volatility here was about 89% going in. Normal volatility about 30. So this one was set up to sell volatility. Now the next day on the 28th, you can see that volatility had collapsed back down to that normal level. And the great thing was the price barely moved. It was up 3.5%. So that's what you want. You don't want price movement. You just want it to stay so you can take advantage of selling volatility. So here's what the chart looked like. It was trading right here going in. The expected move was that it could either go up to 87.5 or down to 79.5. But this was set up just thinking that it was going to sit right here at close to where it was trading, the day before the earnings release. So then you can see that volatility crushed there. So here's what it looks like when you do an iron butterfly to sell that credit. So here it was selling the, you can see it's selling the 83.5 call, buying the 87.5 call, and then selling the 83.5 put, buying the 79.5. So that's an iron butterfly. We're basically short a straddle and long a strangle. And look at the amount of credit, brought in $2.98, so $298 credit. Now the difference is your risk. would be 102. So this is a really great trade setup, to take advantage of, fairly low risk, but if you get it right, you've got a huge potential profit. And so if you get that $298 profit, you're looking at, 292% return. Now this one actually went out making 250 per spread, or 252. So really a perfect scenario kind of trade setup if you get it where it doesn't move outside of that range. So you can see it looks like a butterfly, and it is a butterfly. It's an iron butterfly. And so you can see here, it just pretty much stayed right around where it was trading into expiration, and took advantage of the volatility collapse in theta K going to zero. So you can see the credit spread here on the call side was set up at $1.50, and then it collapsed down, covered back at 40. So you had a nice profit there, and the put credit spread was at 148, and it was at zero, so max profit there. So a total of $258 or 252% return in one day. So that's a really great one for, again, it's just the ultimate volatility collapse type trade. Now, next, let's go to what I call our go-to earnings release trade. So here's the double lightning spread. So basically, out of all the different strategies now, I used to use the other three quite a bit, but since we started using the double calendar, have not used those at all because the risk reward parameters are so great with this strategy. So you can see here's from the inception, when I started doing these earnings alerts out back in June of 2019 to the present, on the 5th, we've had 98 trades closed out, 80 winners, 3 break even, 15 losers, so 85% winning rate. So these are full disclosure, unaudited, but these are kind of summary of these trades. And since 2020, we've been just using the double calendar, and that's really spiked up, our probabilities of winning trades. So that's what the results look like currently. Now let's take a look at why to do it. So first off, the double calendar gives you very low risk. They're non-directional, so if it goes up or down, we don't care. Structured for low defined risk, takes advantage of that pre-earnings high implied volatility because we're selling volatility in time. So we're selling time and volatility, profits from that volatility collapse, and it also allows the trade to profit from any post-earnings trend. Okay, that's a really nice extra kind of flexibility that this offers. Trade durations can be 1 day up to 1 week. Gives you always a positive data, no time decay. So here's a couple more examples. This is one that we did with the alert service. This was on DHI, and doing this double calendar for earnings volatility collapse. So this was done in the last earnings cycle back in July, and you can kind of see, I won't read through the whole thing, but here it was, the alert service sent this out, and so it says DHI double calendar spread, trade for more advanced trader. Okay, earnings before market open on the 21st, expected move up is 6% up or down. Trade constructed for a range-bound move around expected move, so constructed this for 4% up, 4% down. So then took it off, on the 22nd, and going into the trade, first thing I look at is risk. The max risk on this trade spread was $108, and then on the exit, on the 22nd, it was trading at 76.72. It was up $55 per spread, 51% in 2 days. But the big thing was the spread risk is only $108, and sometimes we'll get even less. I'll show you one that we did just yesterday. It was a total of $29 risk, which is unbelievable. So here's what it looks like. It was trading right here. You can see the implied volatility collapses. That's what we're looking for, selling volatility. So it's trading right here. And then the next day, or on the 22nd, it was trading right in here. So it was up to 76.72. So not much of a move, but a little move up, and we had a great return on this trade based on that. So 1 second here. So the question is, how do you decide whether stock price will move more or less Okay, yeah, that's where we look at the price history. That's one of the most important parts of the trade setup. Um, so that's what we want to look for is, price history. So we'll talk about that a little bit more here later, but that's a great question. That's the first thing you really need to look at. What are the probabilities that this trade will go up or down? We look back at past earnings cycles to see what the kind of tendency is for it. And you can usually get some kind of general trend. And then we look at what we call the volatility skew is the other thing to look at. So here's DHI going into its earnings on the 20th, and then it was trading at $73. So this was doing a short the 22 July series, long the 29 July, okay? So this was the expected move going into the option release was 5% up or down, 5.77%, set this up at a 4% move up or down. So again, you can see the volatility here was 97.43 going in. The day after, now it was 53.20. So we're selling that front end, buying the back end, and we take advantage of that volatility collapse. So that's one part that we can take advantage of, plus the theta decay, plus any potential move up or down, we can still be in it if we want. So here it was, here's your double calendar. That's what the profile looks like. And so we had a put calendar here targeting 70 right here. That cost $53 per spread. And then we had the call calendar here targeting 76, which was $55. So total risk, $108. Now you could do this as just a one count calendar. If you think the market's high probability to go down, you can just do this as a put calendar or a call calendar. So this went from 108, that was your spread risk. Now it was trading here at 76.72. So the spread went from 108, now it was 163. So that was a profit of 55 per spread or 51% return, in a 3-day period. So just selling volatility. So this is not even trying to trade directionally, it's just taking advantage of volatility. But if we wanted to think, okay, what if it keeps going up? We could stay with the trade because we're long. In this one, we were long the 29 July series, short the 22. So if we want to stay long the call, we could, or if we want to stay long the put, we could. So it gives you that added option, which is the thing I love. Options give you options, right? So here's another one that we did. These are all alert trades. These were sent out to alert members. This was on T-Mobile. This was a really nice one. So again, you can see the same setup. With the alerts, I pretty much really go through to explain exactly what to do so there's no confusion. And so this one was set up with a max risk of $124 per spread. We had trading at the exit, it was trading at 123.14. It was trading at 125 when we set it up. And so this was a profit of over 130 bucks or 105% return in 3 days. So here's what this one looked like. Again, it was trading right here going into the earnings and then had that volatility collapse. And then we had a move down, not much of a move down on price. So the double calendar was set up on the 26th, trading at 125. Set the expiration was for the 29th, 3 days later. And at that point, it was trading at 123.14. So here's what this one looked like on its risk profile going out. So again, you can see this was a call calendar at 131. That was that point right there. And then we had the put calendar 122 right here. And it was going out right here into expiration. So this was up $130 per spread. So it went from, the spread was 124, and now the spread was at 255, that spread, and 124. So this is $131 per spread or 105% return in 3 days. But the big thing is that spread risk there. And look at the break even. Look how much further out. That's the other thing that makes these so attractive, because if you look at the break-even point, it's really hard to lose that max profit, that 124. So if you look here, here's 131. Now the break-even is right here at expiration. That would be about 135.5. So it'd have to go this one whatever percent. That's a huge move, and that's just to be a break even, or here for break even on the downside. So very, very low risk type trade setup. So that was one on T-Mobile. And here's another one to show you. This was on Disney. This was a earnings cycle, the first of the year. So this was a Disney double calendar. So this one we had risk of 83 bucks, and it was trading at 145 when set up. Exit was trading at 152.16, so up $61 per spread, 73% return. So again, you can see the similarities here. Here's where it's trading. It pops up here, but volatility is what we're really looking for. When we sell that volatility, we take advantage of that crush. So we set this up at expected move 7.5, set it for 6% up or down. And here's what it looked like going out. So it's trading right here. So you can see the 155 calendar on the call side, the 137 trade right here. So 1 day to expiration on that. So here's another one that we just did yesterday. This was on CAG. I'll show you what this, well, I'll show you how just low risk these can be. So here's the trade that we did yesterday on this, and this is CAG. So yesterday we set this up, went out, traded about 33.88, and now it's down to 32.50. So we did this a double calendar, and look at the total risk on this one. This is let's see here. So we've got the 35 calendar, so long the 14 October, short the 7 October. That's for tomorrow's expiration. And then long the 14 October 32 put, short the 7. Okay. So look at the risk on this trade, so low. So the call calendar costs 14 bucks. The put calendar costs 15. So the total risk, $29. Okay. So that's 29 bucks, but actually to break even, the break even is out here like to 36. So it's going to be hard to lose on this trade. Now this one's up $1 going into the close here today, but if we get into tomorrow and it is trading around here, if I can erase this stuff, this will be up tomorrow about, depends on where it goes out, but we know a worst case scenario is we could lose 29 bucks. But if it was to go out right here at 32, right here, it's currently at 32.56. So if it stays here tomorrow, it goes out here, that'll be about $8. If it goes back down to 32 though, this will be up close to about $28, $30. So 100% return. So that, dollar wise, sometimes these are not big, but when you look at the return on your, capital at risk, these are pretty decent little returns. So this was a really low risk one. We'll see how it does. But that's the beauty of it. And then if you wanted to, if you think, okay, well, I think it could go lower, we can hold the trade for a bigger move to the downside and, take advantage of any post earnings move here. So if we think tomorrow maybe it'll go down further, we could just go ahead and close out the other short strikes and just stay along the put or convert the put into a put debit spread or something like that. So we may want to do that. We may decide tomorrow, okay, let's hold on that put and see if we get a move back down here, maybe next week to 31. So we'll see what the non-farm payroll does, and then that might be the option that we take. So, if you'd like to learn more on how to start profiting from these kind of high volatility earning strategies, I'm going to be doing a workshop on this, not this weekend, but the next weekend. So let me go through all the good benefits that you'll get if you're interested. Hopefully you'll join us. Let me show you here. If you not lose, but if you use this link here, it's got 6 bonuses that are part of this package. So the course will be live and recorded. So this will be Saturday, the 15th of October, 11 a.m. to 2 p.m. Eastern. And then we're going to do a Q&A the following Tuesday, 11:30 to 12. So we're going to, with this package, you get 6 nice enrollment bonuses, a total value of over 2,400 bucks. So let me show you what the bonuses are, all the different stuff that you'll learn in the course, and then go through any questions that you have. So use this link here, and you can use that. click, let me send that out to you, make sure it works. So click on that. It should just pull up a payment link here. And it works. Yep, sure does. Works fine. So you'll see this payment link pop up, credit card, PayPal, $197. All right, so that's if you want package one, which we'll go through. Let's go through that now. So here's course package one. So this is just the earnings course without the course package two will be if you want the alert service. But here is with just the course. So this will be a 3+ hour course live. But to start off, you'll get my course that I did the last earnings season was July. So you're going to get this right away, so you can start, working on the course right away, and then we'll follow up with the live course, which will cover, a lot of the same material, but always kind of some new examples, etc. So this course on the website right now would be $497. So you're going to get this right away, so you can start if you want, tomorrow, if you sign up tonight. So then as an additional bonus, you'll get 30-day trial membership to my trading club. You can start that whenever you want. And we'll go through the benefits, what you get there. So that's $97. Then you're going to get my Start Trading Options Today. It's a beginner's option course, a really nice course to get you started if you want that. Then 4, we'll do a live follow-up Q&A. Bonus 5, we'll do, how the pros use the Greeks. So this is another kind of tutorial on the option Greeks. And then you'll get my forward trading list of the best stocks for earnings. So the question earlier was, how do you decide what stock prices or what stocks to set up, how much they'll move? These lists here will give you that kind of information. Plus the course will take you through exactly how to analyze and the resources I use to do that kind of history analysis. So those are the 6 bonuses you'll get. And one-time payment, $197. And it's all yours there. Now, if you want it with the alert service, if you've been looking for more help and guidance, you need some more, help in your trading in general, this trade alert package would be great for you. So with this package, you'll get all 4 of my alert services for the next 3 months, and then you'll also get my Power Cycle Trading Club for 4 months for an additional month there. So this will be everything in course package 1, which is $197. 3 months to the alert service, all 4 alert services, 4 months to the trade club. Now, the 4 different alert services, I send out if we have an earnings trade, I've got the earnings alert service, breakout reversal alerts, okay? So these are usually debit spreads, anything butterflies, long condors, so that's a separate kind of alert service. And then I've got alerts that I send out for calendar or calendar diagonals. So, it can vary. So from day to day, we might, like the other day, we did a couple calendar diagonals. Earlier last week, we did a butterfly apple. It just varies. And then we did this CAG trade on that earnings trade here just yesterday. So it just depends on what's coming up. But those are the 4 alert services, and you can start this anytime and stop it and pause it if you go out on vacation. So with the alert service, you'll get 3 months to the alert services, 4 months to the Power Cycle Trading Club. And let me give you that link here. So if you're interested in that one, which is a great deal, it's $597, which is a super low cost deal. If you look at, I don't know what other services are. I've seen some of them that are much higher than this. And so with this one, you're going to get some extra really good benefits as well. So just use this link here. It's got a 2-pay if you'd like. So total cost is $597. So that gives you the earnings course, all the bonuses, plus the alert service for 3 months, and the Cycle Trading Club for 4 months. And if you want, there's a 2-pay here. Just go down here and click 2-pay, and you'll get this one, at a 2 payment. So you could jump into this for $331, and then your next payment would be 3 months later. So that's course package 2, and that was the Earn Alert right here if you want to use that. So with this service, you'll get 10 to 15 stocks or ETFs per month, either earnings trade setups, breakout reversals, calendar diagonals. We do a lot of calendars and diagonals, quite a few bunch of butterflies and long condors, so you'll get all those. I send out a trading guide for each trade alert. You'll get a setup video review of the trade after the after the close. Trades are all listed and archived. You get access to my weekly Q&As, which are usually every Tuesday, so you have that for the next 4 months. I do a daily video newsletter every day after the close. You'll have that for the next 4 months. My virtual trading room open every day during the week, 9:30 to 10:30 Eastern. You'll have that for the next 4 months, and discounts of 60% off any course or software on my site for the next 4 months. So here's the overall cumulative results for the all 4 alert services put together. So I started the first alert service back in 2018. That was a breakouts, and then through yesterday we have had 517 closed, 399 winners, 19 break-evens, 99 losers, 81% winning rate here. So again, these are unaudited results, but it's been a really, I really look at trade setups to really look at, low risk and high kind of return type of percentage type trades that are kind of repeatable, high probabilities of winning. So breaking it down again, I showed you the earnings. We've got 85% winners so far on that. On the counter diagonals, started this back in 2019. Through yesterday, we've had 157 trades closed out, 123 winners, 5 break even, 29 losers, 81% winning rate on that. And so these are a lot of times longer term type trade setups. We've got 2 currently on. We've got one on Newmont Mining we just did, and then one on CF Industries. So those look real good. And then we've got another short trade set up on IYR using a put calendar diagonal. So those were, some that we just sent out recently. And then we've got the butterfly service that is also going to be included. So this I started back in 2019 as well. So we've had 106 closed out, 81 winners, 5 break even, 20 losers. Again, 81% win rate. These are very low risk trades, typically maybe on average 50 to 100 bucks per spread. But with the butterfly, you get 2 to 1, 4 to 1, or sometimes even higher. And then the first service I started was back in 2018, the breakout alert service. This is typically mostly either, put debit spreads or call debit spreads. So we've had 156 closed out, 115 winners, 6 break even, 15, 35 losers, 78%. So most of the trades that we're doing currently are going to be either the calendar or butterflies, and then the earnings trades that are, very, very selective. So with the course, what you're going to master is in part 1 and 2. So this is kind of broken down into multiple parts. Now, part 1 and 2 will be live, because this one is what we're going to focus on. And this is going to be just teaching you how to use this double calendar, everything that goes into selecting the stocks that are good for it, and then how to set it up and, execute the trade and manage it. So with this, you'll get, basically we'll go through 5 steps to the perfect trade setup, the analysis tools used, and how to use your analysis to analyze the past statistics. Then I got a 7-step screening process to pick out the most probable winners. Option pricing, importance of using weekly options. My resources that I use for the statistics for the earnings history. So you'll get all that, and then we'll go through in detail how to analyze the statistics, how to quickly scan and capitalize on this valuable earnings data. Okay, so this is where the start of every trade really starts out here. So this will be a big part of the course, how you do that analysis. So very, very valuable. How to analyze the stock earnings release move or post earnings move to select the best, weekly option strategy. And then kind of my formula to create the, kind of a really efficient watch list for these types of trades. So we'll go through, there's a lot of detail to cover, with all this. So that's part 1 and 2, which are live, and then part 1 and 2, which is live, where it covers the double calendar, okay? So to me, it's the best earnings strategy I've found for earnings, as well as just an overall excellent option strategy, period. So because the risk is so low, these things provide, great returns on low risk. So you're going to learn in depth how, why, and when to use this dynamic strategy based on 10 steps that I use for, the trading guide for entering to enter the trade. So the details of this double calendar will include how to choose the optimum option strike prices, how to structure the initial setup through option expiration with ease and perfection, and then steps to adjust an earnings double calendar into a free trade. So, have had time to cover that. But a lot of times what we'll try to do is, can we convert or adjust this to a free trade, which, has zero risk. So tomorrow we'll be looking at that CAG. We might be able to adjust it maybe to a free trade into maybe a put debit spread or something like that. So, cover this in the course as well. And then part 3, which is the recorded part of the course, which will give you the other 3 option strategies that I used to use quite a bit, but I've since not, but you might see that you're interested in using them, will be to go through these non-directional trades: the long iron condor, selling volatility, the long iron butterfly, volatility, and the short iron condor. So with this part of the course, which is a recorded part, you'll get these 3 strategies with, very good detailed explanations and examples of how, why, and when to use these trading strategies, how to construct the trades based on the pre-earnings implied move, how to calculate the implied move, and then set your trade up. So this covers really everything that, as far as any of the earnings strategies that you could potentially use. How and when to set all the trades up, how to manage into expiration, how to defend, and you'll get a trading library with a bunch of past trades that you can go through and look at. So kind of a library here of over 40 trades from Apple to Google, whatever. So the difference here, you'll go back and kind of kick the tires to see how they work. A little feedback from Mary, who took this, and I appreciate this very much if you're here, Mary. One second here. How the provide during COVID? Fantastic. It's all based on swing trades. So if the market's going up or down, it just doesn't matter. I'm selecting trades based on the cycle of the market. So they did great. So are you? Yeah, well, 365, I'll be there. Yeah, I'll be presenting there. Hopefully, make sure you sign up. Let me see here. Yeah, if you want to, yeah. Let's see, Tim, I'm trying to read through here. Yeah, here, Tim, use this link here if you'd like to. If you've taken this before, here, use this link, you'll get a discount on it. Let me give you that real quick here. Please join us. Here you go. Okay. So, yeah. Okay, one second here. Will this course teach you how to use a butterfly to pin a daily close on SPX? No, because this is on earnings. This isn't trading SPX. But if you ask me, I'll be happy to show you how to do that in the course. Or you can, as a member of the trading club, you can buy my butterfly course, which goes through in great detail. But I'd be happy to show you in the course if you just ask how to do it. I will be happy to show you pretty quick on how to kind of, put the butterfly together for SPX or SPY. So here's the link again. Use this for package 1. And so Mary, so this course explained in clear and simple terms how to trade options on stocks that are coming into an earnings release. Larry showed with specific sources of information used to determine which strategy is most appropriate for the stock that is reporting based on historical data. He gave very specific guidelines as to the use of each and also the exit strategies. Larry goes over the material in great detail and shows examples of these strategies from past performance. One thing that impresses me with each course I've taken is his willingness to repeat explanations if someone has asked for a clarification. He schedules the classes for certain time frames because he wants to make sure each participant understands the information and has enough time so you can stop and ask questions. So kind of a really good, thorough kind of summary of the course in general. And then here's all the different special enrollment bonuses that you'll get. And here's the alert service package link here. This is $597. Hold on, Charlie. So use this link here for that. All right, so you're going to get the on-demand 3-part earnings course. This was done back in July, so you'll get this right away so you can start studying the course if you'd like to start out real quick. So this is a 7-hour recorded course, 428-page training manual. This course, again, will go through on-demand 4 option strategies to use: the double calendar, iron butterfly, long iron condor, short iron condor. So you're totally covered for every type of strategy that you could possibly use. So complete earnings option guide, in-depth explanation with examples on how to use these strategies, trade examples, how to maximize your earnings price using short iron condor, the right way to sell volatility using the long iron condor or long iron butterfly. So very, very great course you can start out with here, and then we'll follow up on the 15th with the live course. So that's bonus 1. Then bonus 2, you'll get 1 trial membership month to my trading club. Now, if you do the alert service, you get 4 months to this. So with the trading club, you get my virtual trading room open every day, 9:30 to 10:30 Eastern, Monday through Friday. So come on in. If you have any questions on a specific stock you're looking at, or what, an option strategy or whatever we're looking at doing as far as trades, that's where we're going to do it. Then I do a daily video newsletter every day after the close. Trading videos are archived. Live Q&A every week. Traders Educational Vault, I'm adding to that with some really good stuff. And then 60% discounts on all courses and software. So you'll get all that. That's the trading club. You'll get this for 30 days. Now you can start this whenever you like. You don't start it if you sign up tonight. You can wait until after the course or start it whenever you like. So you'll get that. So just wanted to say my option knowledge has leaped exponentially since joining your trading room. It says, Jay says, reading books is fine, but seeing the actual option trades setups makes a huge difference. Thanks, Jay. So, that's kind of summarizes it there. And then just as an additional option course to add to your library, I've got this beginner's option course that I did just a few months back, Start Trading Options Today. So this is on-demand to get you started trading options. If you've not started with options, this will kind of get you into it. So comprehensive, easy to understand course goes through the benefits of options versus stocks, insider trading tips, must know option basics, mastering puts versus calls, what and how option expiration works, and 2 different beginner option strategies, covered calls and a protective collar strategy are part of this course. And then bonus 4, we'll do a live follow-up Q&A. Okay, so this will be live and recorded, and then that's to give you additional support. Plus, you're getting 30-day trial membership. So if you have any questions, you're going to have plenty of time to get questions answered and go through all the stuff there. And then 5, you'll get my How the Pros Use the Greek. So this is just another option basic tutorial, 60-page option guide with videos on really looking at the Greeks, delta, gamma, theta, how option pricing works, what we call the market maker secret, what that is, standard deviation, option delta. So another just really great course to add to your library. And then you'll get my earnings stock watch list. You're going to get my 5 top earnings watch list. These are going to be based on some scans that I do, which you'll learn how to do these scans yourself in the course. So for example, these are scans, 3 different screens that I do. One is I look for anything stocks that are coming up that have had moves of 5% or greater, up or down. And then I look for different ones that stock movements of less than 7 or less than 5, and then my favorites. So here's an example of last July what was sent out. So you can see here this list one was max 5%. So this is these are stocks that tend over the last 4 cycles they've not moved greater than 5%. So this gives us a good place to start for looking at these trade setups. So J&J, ABT, UMP. So these lists will get, sent out to you, and then you'll also learn how to do the scan yourself, so you can do it yourself. So that's list one. List two, max move of 7%. So these are all stocks that have had no greater than 7% moves or less over the last, cycle. So these, you can see this was going out to July 20th. These went out to August, so I couldn't put the whole thing there. List three, these are for stocks that tend to move greater than 5%. So you can see these are high volatility stocks that have huge potential moves. Spotify, PayPal, etc. So a lot of different ones there. And then I'll give you my favorites. So these are the ones that we keep going back to the well on. So American Express, Taiwan Semi, T-Mobile, Disney, things like that. So you'll get all those, and it shows you when the earnings will be, what strategy to use. So here, these double calendar. So that's you'll get those four lists. And here's an update on what you'll get if you go with Elite Open and Close service. From Wally, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out a lot of trades. Some are good, others are not that great. But one thing that I'd like everybody here to know on the webinar is that when I get a trade alert from you, I do it blindly as time has shown. This man has dead accurate in his recommendations. Thanks, Wally. And this was from Scott. If you're here today, thanks, Scott. It'll be the best investment that you'll ever make. Go with the Elite package, great group of traders as well. So thanks for those support there. So again, the Elite Open and Close, 3 months alert service, all four earnings, breakouts, calendars, butterflies, everything in package one, all bonuses, $597 for this, and there's 2 pay if you like. So you'll get a suggestion option trade. So a lot of members just do their own thing, but I will always give you an option trade to use. What the entry levels will be, profit target levels, option series to use, stop loss, guidelines, trades are listed in archive. Now I'm constantly updating these things throughout the day. So today we had a bunch of different updates. I'll show you kind of what it looks like. We use a service called Telegram. And so you can see here, just for today, I sent out alerts saying, okay, Newmont long trade around 44.63. If long, this is the trades that we set up just the other day, the 28 October 43 call short, the 14 October 46. Make sure to have taken some profit on these moves higher. US dollar higher again creates a headwind for the metals, currently up about 30 per spread or 14%. So I'm just constantly updating you with the alert service. Here's one I sent out today on CX. Industry said trade around 107.52. Again, had a nice take some profit here for long multiple contracts, currently up about 60 bucks per spread. And then here was the alert service sent out. This was on KAG, that was sent out yesterday. And Newmont says Newmont long. Here's what it looks like when you get a new trade. Here was the trade sent out on Newmont. Let me pull that up. Apple, we did a butterfly. Okay, here's new CF long there. So that's kind of what it looks like. These go out within seconds, so really fast. And so you'll get all that information there. Trade setup video review, daily market newsletter. You'll have that for the next 4 months. Weekly trading review and Q&A every week recorded for the next 4 months. Access to the virtual trading room for the next 4 months. Discounts on all courses and software, 60% off. So come on in and take advantage of that. Again, we've had 81% win rate. And here are some other examples. Here were some earnings trades. So this was KG, said well worth to get all the trades from Larry over a year on your cell phone. This is back when I first started, paid 1,200 bucks for it. He made it back in his first trade on that one. So the earnings release trades, we're going to be 85% win rate there. Showed you these earlier, but flipped them again. This was the double calendar we did on DHI. So this was that one here for 55 bucks, 51% return. Here's the other one, T-Mobile. So I showed you this earlier, but here's some others kind of samples. Here's the butterfly long condor alerts, So we just did Apple, we just did SPY, and the SPY trade, you can see here, it says new SPY short trading at 378.91, market below prior day's low by one butterfly, the 26th September, 377, 370, 363 put butterfly around $1.10. And then, we'll give you updates as to when to get in, when to get out. And here's what that trade looked like. This is using my trading model. You can see perfect entry here was boom, broke this trend line and pushed down hard. And so we did this butterfly. Total risk is the thing I look at first. This one we had set up for max risk of $115 per spread. Had potential to make over 800, and this ended up making $240 per spread, or 208% return in 5 days on that butterfly, with a lot of potential profit in there actually left. So that was a example there on SPY butterfly. And here was one on Tesla we did recently in September. This was a long butterfly, got in right here, targeting up here about 300. And so we did this with a wide wing butterfly here. So a risk of $225 on this butterfly, and made 418 per spread, 186% return. So those are just kind of some samples of the things that you'll get from the alert service. And then here's counter diagonals. There's one we just did recently, XLB. So this was a materials ETF. We did this with a put counter diagonal. So you can see the description, new XLB short trading around 72.20. Looking for a retest of the July low at 70. So buy counter diagonal, buying the 21 October, selling the 22 September at $1.10, and then exit here. So here's what this one looked like. So set this up right on that break there, targeting down here to 68. So we did this with a put counter diagonal. So this was set up at $205, and then ended up making 83 per spread, or 40% return in 6 days there. And here's another one we did recently. This was on Phillips 66. So this was another really good one. So ended up $160 per spread on that. So a lot of great stuff. Now, again, if you want the package one, let me give it to you real quick. And I'll show you the other one. We're currently long IYR on a put calendar diagonal. I'll show you that one real quick, and I'll show you everything we've got on. So these are alert trades. I'll show you a few others here tonight. So here's the alert package right here. No, the alert, the Telegram, I sent it out as soon as I put the text together. So it varies. Okay, so that's what you're looking at there. Now here is, I'll show you a couple of trades that we have currently on. We have, so it shows you CAG. We have also, we're short IYR. This is a put calendar diagonal. So we're short this trade. We're it went out today. It's starting to break down again. So we've got this trade set up where we're long the 21 October 79 put, and then shorted against it the 14 October 78 put. So up about $4 now. If next week the expiration, it goes out at our short strike that we're targeting 78, this will be up $135. On the risk of, this is a super low risk trade. This is, we've adjusted this down now to a cost of $69 per spread. So here's the current trade right here. Look at the cost, 69 bucks is the total risk. If we get a move to 78 next Friday, this will be up $130. So over 200% return there. So that's one we have currently on. Then we're currently also, we have Newmont. We did that just, I guess 2 days ago. And this one had a nice spike here today. Was up about $60, $70 here. Sent out an alert to make sure to take some profit. So we're currently long this one. I can shrink this up. So we've got this call calendar diagonal. So we're long the 28 October 43 call, short the 46 14 October at 207. We get a move to 46 next week. This will be up $153. And then we've got one other. We've got CF Industries we set up the other day. This was with what we call a volatility squeeze. So we have this set up. It's currently up about $40. So we have the 28 October 103 long, short the 14 October 107 at 389, up about $40 on that one. So those are kind of some current ones, just to give you an example of what you'll get if you'd like to do the alert service. Okay, so that's pretty much wraps it up. Again, here's everything you'll get. All the 6 bonuses, $2,400 value, $197. If you'd like it with the alert service, you'll get 3 months of the alert services, which you can renew if you want to after that, 4 months of the trading club. So everything, all package 1 plus all bonuses plus the alert services, $597. And that's everything you'll get there. And to get you started before the course, you'll get the course I just did in July to get you rolling right away. So I hope this was helpful to you, and hopefully you see a strategy here that you'd like to learn. And I look forward to working with everybody here. So appreciate your time spent here today with me. Any other questions at all? The renewal rate is typically the same. If you sign up for this rate, I'll usually just grandfather it in the same. That's what I've been doing. I started out with the alert service kind of a longer term, but I've kind of cut it back to, kind of a quarterly thing. All right. Well, again, thanks so much. And